Hi everyone, welcome back to Wednesday Moves. This is episode 11 of our step by step trading education series. If you have been following along, you have already learned many concepts. But today we focus on something very important, how to bring everything together into a simple practical framework. And if this series is helping you, consider subscribing so you don't miss the next lessons. Many people struggle with the trading not because of lack of knowledge but because there is no structure behind their decisions. Without a framework, it's easy to feel confused or emotional. A framework helps bring calm, clarity, and consistency to how you approach the market. It's important to be clear about what a framework actually is. It's not a guaranteed system, it's not a shortcut to success, and it doesn't need to be complicated. In fact, the most effective approaches are often very simple. Most structured approaches share a few common elements: understanding market direction, identifying logical entry areas, and applying proper risk management. When these pieces work together, trading starts to feel more organized instead of random. Market bias, it simply means observing direction. Is price generally moving upward, downward, or staying within a range? You don't need to predict the future. You only need to observe what is already happening. It can be bullish, the market bias can be bullish, can be bearish, or it can be sideways. So here's an example. This chart shows an example of upward direction. You can see price gradually making higher highs and higher lows. Observing this kind of structure helps you understand the environment before making any decisions. Entry area. Entries work best when they are based on logic, not emotion. Instead of reacting to every candle, it's better to wait for areas that align with structure and context. This helps reduce impulsive decision making. Risk management is one of the most important parts of trading. It's not about trying to make the most money, it's about protecting capital. So you can stay consistent over time. Responsible position sizing plays a key role here. Consistency over frequency. Like many beginners believe they must trade every day. In reality, consistency matters more than frequency. Fewer well thought fewer well thought out decisions often lead to better long-term development. Common beginner mistakes. It's common to see beginners jumping from one method to another or over trading without a clear reason. Progress usually comes from slowing down, practicing patiently, and focusing on learning. Now, how to practice? One helpful habit is keeping a simple journal. Write down what you observed, what you considered a trade, why you considered it as a trade, and what happened afterward. Over this time, this builds awareness and supports steady improvement. Well, a simple, structured approach applied consistently is generally far more effective than random decision making. Clarity comes from structure. Learning trading is a gradual process. There's no rush and there's no shortcut. The goal of this series is to help you build understanding step by step. Subscribe if you would like to continue this learning series. Thanks for watching. I'll see you in the next episode of Wednesday Moves.